Here's how you can use the wheel strategy to boost your trade returns. So the wheel strategy, what does it involve? Well, when you go and trade options, you can do them by buying or selling puts and calls. You can also buy and sell shares of normal stock. But if you use the wheel strategy, you will actually get paid to sell options twice. Here's how it works. When you open up a trade, first with the wheel strategy, you want to get assigned shares of stock. This is preferably stock that you want to own. Long-term is best in this scenario. What you want to do first is sell a put. When you sell a put, you take on the risk of getting assigned 100 shares for each contract you sell. So for example, if you sold a put on the S&P 500, the SPY, the SPY, you would get paid X number of dollars. I'm going to show you an example in a little bit here, but you're going to get paid X number of dollars to sell that put. So instead of just buying 100 shares of the SPY at the current market price, you're going to sell a put, even if it's at the current market price, you're going to sell a put and get paid a little bit of money, thereby lowering your cost basis. That's part one. Next, as time goes by, hopefully in this scenario, the price of the SPY will go down a little bit underneath the strike price that you selected when you sold your put. For this to happen, again, the price goes down, then you end up getting assigned the shares that you sold the put on. So 100 shares are going to end up in your bank account. After that happens and they're in your account, you're locked and loaded, ready to go for step two of the wheel strategy, which involves selling a covered call on the shares you now own. So step one, we sell the put. Step two, you sell a covered call. And a covered call is just saying that you are agreeing to take on the risk of having those 100 shares of stock called away. That same 100 shares of SPY that are now in your account. So you get paid again to sell this covered call, one contract for 100 shares, but you're doing it so that you gain extra income in your trading account when you sell the put and when you sell the call. So you actually get paid twice. And once your covered call goes on and the stock price of the SPY or whatever stock you're selling on goes up, hopefully those shares will get called away, freeing up your overall capital in your account once again to go and repeat the process. So step one, sell a put option on stock you actually want to own long-term after it gets assigned to you. Step number two is selling a covered call on that same stock and having the shares ultimately called away. You get paid when you sell the put, you get paid when you sell the covered call. Once the call is done and the shares are outside of your account, you can then go back and redo this whole process on the SPY or whatever stock you want, completing the wheel scenario in this example. So how does this benefit you as a long-term investor? Well, if you're going to buy these shares of different stocks anyway and add them to your portfolio, you might as well get paid a little bit extra to do so, right? Doing this, selling the put and then selling the call, gives you the ability to earn those little bits of income that over time can compound. You probably know that phrase, compound interest, but you can compound your returns using the wheel strategy for your options trading. Doesn't have to be fancy. Doesn't have to be super in-depth. Just sell puts on stock you want to own long-term anyway. It's no different than going and buying 100 shares of stock, except that you get paid a little bit more to do it up front. And on the back end, you're making that little bit of juice to get rid of the stock and sell it back into the pool of other investors out there who want to gobble it up. I love this strategy for three reasons. Number one, it's super easy to execute, even for beginners, as long as you have the cash in your account to do so and you're not using margin. Number two, you can do this from almost anywhere. You can do it from your desktop, your tablet, your mobile phone on the go. It's that simple to execute when you really know what you're doing. And number three, you can sit back and wait for these positions to kind of move around. You don't have to be in the market checking everything every day. It's stock that you've done research on, hopefully at the beginning, so you know you want to own it long-term. You're confident in it. That confidence gives you more ability to not have to go in and check your trade every other day or every trading day. You can just sit back and relax and get a little bit more extra juice in your returns and boost your trades from the onset. Here's an example from Interactive Brokers showing you why this is so powerful. Now, the SPY is currently trading at 544 and change. If we wanted to buy 100 shares, 544.36 times 100, it's going to cost us just over $54,000 in our account. We could do that, or we could use step one of the wheel strategy to get a little bit of a boost on our overall position. So how we do this, we go into the options chain for the SPY, 33 days out roughly, so about a month away. We go to the same rough price that the SPY is currently trading at, so 544, and we look to sell a put right there. This is an example, right? We could do this and get paid roughly $6 per share. Each option contract, one contract equals 100 shares. So 6 times 100 equals 600. So the difference here, when you use the wheel strategy, even the first half of the wheel strategy, right? You're getting paid $600 to sell this put option, which again gives you the risk of having to buy 100 shares of the SPY, which you want to do in this scenario anyway. So really, you have $600 in cash that is going to lower the entire purchase price of those 100 shares. Think about it this way. You could pay 54.36 times 100, so 54,000 and change. But if you get a $600 discount on that, because who doesn't love a good discount, right? You're actually paying 53,836, saving yourself about $600 in cash by using step 1, selling a put for the wheel strategy. Now, let's assume you get those shares assigned to you. So we just paid a little bit less to do this, right? Now we have the shares in our account, and when we want to go back and sell them, let's say the stock price of the SPY doesn't change at all theoretically in a vacuum. It stays the exact same at 544, and we can turn around and sell them now for 544.36 on the open market. If you were just a buy and sell kind of trader, you'd make no gain at all. It would just be a wash, right? You'd be buying them for 544.36 and selling them for 544.36. Oh, tongue twister here. If you were to sell a covered call, though, at 545, just like a couple cents higher than the current stock price, you'd get paid again to do this. And this is where the power of the wheel gets harnessed. You could get paid, we're going to call it $9 per share just for easier calculations here. The bid ask is showing 915 and 919. We're going to say $9. Again, easy math. So we get paid $9 times 100 shares. Boom. $900 more to sell this stock. So again, if you bought it for 544.36 and you sold it for 544.36, your profit would be 0 if you're just a buy and hold kind of stock trader. If you're using the wheel strategy for options, you would pay that 544.36, right? But you get a discount at $600. So it only costs you $538.36 to buy. And then on a sell, you get to add on another $900 of profit. So overall, when you take and you add in the $600 plus the $900, you get $1,500 of additional profit in this trade that you wouldn't have gotten if you were just straight up buying and selling shares with no wheel strategy to enhance this. Now, it may not seem like a big chunk of change on a $50,000 trade. Even if we do this, 1,500 divided by 54,000, it only works out to about 2%. But if you compound 2% on every single trade that you do over the next X number of years, it can really add up. If you're going 10, 20, 30, 40 years in the future, just juicing up these returns a little bit can really dial up the long-term potential for your portfolio overall. So the key takeaway here for you and how you can apply this in your own trading for your own portfolio, check to see if you have the ability to sell puts in your trading account. A lot of tax sheltered or tax kind of safe accounts you can't sell puts on, but unregistered accounts you can. So just check what kind of account you have and see if it's a possibility. Most accounts will let you sell covered calls because it's seen as less risk because you already have the shares in your trading account. But see if you can sell puts. If you can, consider selling puts on stock you want to already own. If you have a big portfolio full of Apple, great. If you want to add some more shares, you want to add 100 at a time, consider selling a put option to lower your cost basis. And then maybe you want to sell a covered call down the road, 30 days, 60 days, 90 days, in a year, 2, 3, 5. It doesn't matter. You can do it whenever you want to in the future. If you think Apple's about to go on a big run, maybe you wait a little bit, see what happens, then sell a covered call, get paid the other half of the wheel strategy to juice up your returns. And again, the way that I like to use the wheel strategy for my own trading is doing it on stocks I want to own long-term, long time. I don't use it on any kind of speculative plays. I don't use it on any kind of short-term plays, only good quality stocks that I've invested in, I've done some research on, and I want to trade long-term. That is how I use the wheel strategy to boost my overall returns. Now, if you want to know more about how options trading work, I invite you to subscribe to my channel if you got value here today in this video. And if you want to learn how to master the basics of options trading, calls and puts, everything in between, I have an Options Academy course currently at a 50% discount available to you. I will put the link in the description for you. It's www.tradingoptionsdaily.com/options academy. Everything will be linked again in the description for this video. If you have any questions, please leave a comment. Thank you again for watching. My name is Andy Ferguson, and I will catch you on the next one.